please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Chetan Ahya, co-head of Global Economics and Chief Asia Economist, Morgan Stanley, has joined us now. Good morning, Chetan. Always a pleasure having you with us. And I think we've not had you for some time now, so it's just as well you're joining us this morning. We're getting the big GDP number shortly in about 3 days. The last set of numbers we've had in October have not been very good, as your report points out. PMI was a little under the weather, auto sales were not too good, and exports were quite a disaster. So how should we prepare for this number, though this is of September quarter?
Yeah, exactly. I think the August-September numbers were good. If you looked at autos, you mentioned PMI. PMI was also looking good in September. So broadly, we're expecting 6.5% GDP growth, and this will be a confirmation of the turn in the growth environment that is sort of going to be reported in September quarter. But we do expect that trend to continue going forward too. We think that the moderation that you saw in a lot of the data points in October was a bit of a temporary downtick, and the underlying fundamentals in the economy are good enough to bring that recovery back up again.
Chetan, morning. So I was looking at your projections for 2017. It's, I think, 6.4%. Next year, 7.5%, and then going up to 7.7%. What will be the growth kicker to get us to these numbers? Which particular sector? Where do you see the recovery gathering pace?
So essentially what we're saying is that in 2018 calendar year, or FY19, you will have all the drivers of growth in place. We would have seen further pickup in consumption. We expect exports to be held back at a reasonable level. We are expecting global growth to be strong, so that gives us the confidence that exports numbers will also be reasonable. And the link which has been missing so far is the capex part, and we're expecting private capex to pick up going forward from around 7% of GDP right now to about 8.5% by financial year March 20. So the private capex line also joining in will bring that strength in global growth, India growth numbers that we are forecasting, for it to go to about 7.5% in March 19 financial year.
Okay. Well, let me revisit that export number, although that is of October and not September. September was good. Chetan, have you all dissected why we did so badly? Generally from, January to October, we have not really participated in the global growth story, except for the month of September. Have you analyzed what's going wrong, and are you satisfied that this quarter we will be, those blues will be behind us?
Yeah, there are two reasons. One is that actually all the countries in the region did show deceleration in the month of October. And I like to look at Korea numbers because they tend to be more cleaner when you're analyzing the global trade numbers in the region. And Korea's exports growth also dipped in the month of October. Of course, India has dipped a bit more, and that's probably because of the second reason, that we still have that overhang of GST implementation and its impact on the SME exports. Having said that, the government has taken the measures on reversing that problem that was there for SMEs. And at the same time, when we look at the early indication for the month of November, Korea is quite good in declaring numbers. They've also shown the first 20 days of the month of November export trend that is already beginning to pick up. So we are expecting exports to recover back to about 8–10% average dollar value growth from that very low numbers that you saw in the month of October.
Okay. Well, let me then come to the inflation trajectory and what you're expecting from the monetary policy. Are we going to stick with the 7%, or do you think that there can be substantial hawkishness in the MPC report on Wednesday next, because of crude and metal prices globally?
We think they will maintain that neutral stance. I think the last meeting sounded like it's hawkish because I think the market's expectations was that of it to be too dovish, I would say. I think the language was relatively neutral, and we even, in fact, after the monetary policy, put the title of our report as firmly neutral. And I think that's what it will be. It will still be firmly neutral. They will highlight risks on the fact that there is upside risk building up from higher oil. But we think the monetary policy statement will still be relatively neutral.
Chetan, of course, on Friday, we were anticipating S&P's next move, and we finally got to know that it's a pause from them. They're not as heartened as Moody's with respect to sovereign ratings here. And the big flag from S&P's point of view continues to be the twin deficit issue. How do you view the current state of the fisc here, given that GST revenues are still lumpy? We're trying to understand how the collections are looking.
Sorry.
So what has happened in the last few months is there has been a slippage in the deficit numbers, and its 12-month trailing number for the central government is tracking at 3.6%. When we analyze the breakup of that into expenditure and revenues, it does look like it is more related to revenue rather than expenditure. So the run rate of expenditure year to date is very similar to what you would have seen in the previous years. But the revenue is much slower than what we had seen in the previous years by this time. And that is because of the GST implementation and the fact that the trailing numbers for growth, particularly nominal GDP growth, had not been great. Having said that, going forward, we do see a turn in both nominal GDP growth as well as corporate tax, income tax revenue. And so we think that broadly the government should be able to achieve that deficit target of 3.2%. Might be a small slippage, but not a lot. So I think they're on track of that fiscal consolidation path. I think it's the year ahead is where we are skeptical that they will be able to follow the glide path, because that will be the last financial year before general elections.
Yeah, but that's what a lot of economists are worrying about the next year. And therefore, if you want to show a lower fiscal deficit for next year, then this year you have to show maybe 3.5. That's one of the arguments the market is working with. Do you expect they're going to borrow something in that Jan and Feb 5 weeks, where they've kept only 5,000 crore of borrowing as against 15,000 crore per week in the previous weeks?
Lata, as I mentioned, I don't think that they will breach the deficit target from much more than 3.2. So it will be more like 3.3, at worst 3.4. But I think more likely 3.2, 3.3. So I'm personally not expecting a much big breach in the borrowing target. And the reason is because I think we are, as I mentioned earlier, quite constructive on growth outlook, and things have turned around. We already have the evidence in the September quarter, and I'm sure you will get the numbers in the next few months, which will bring that better nominal GDP growth and tax revenue for the government. So I think that's what will basically ensure. And the government, to be fair, has also been highlighting the same issue, that it is the revenue line where there is uncertainty and therefore the borrowing program.
So what are you expecting by way of direct tax revenues? I mean, indirect tax now are in a state of flux. But how do you expect tax revenues to shape up? We should get those numbers also on November 30th.